presentation contains current opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello everyone, and welcome to the Compak Asset Management YouTube update for October 7th, 2021. I'm Moe Ansari, President of Compak Asset Management and the Chief Investment Officer. First of all, I want to thank everybody that came to the seminar yesterday in Scottsdale. I'm back in California today, but it was great to put some faces behind all the voices, all the people that I talked to. Thank you, everybody. I know we had limited capacity, so we could not accommodate all the people that wanted to attend, but thank you again for coming, all the people that we did, and I'm sure I will be back soon in Scottsdale to do some more seminars. The next Zoom webinar that all of you can attend globally, and hundreds upon hundreds of you are going to be on it, is going to be Wednesday, October 13th. So make sure you register for it. All you have to do is go to compak.com and register, compak.com. And then we'll be in Denver on the 14th. If you would like to come to a seminar there, that's in person. And then October 16th in Los Angeles. So we do have a number of these all lined up for you. If you want to attend, that is your opportunity to do so. But again, seating is limited because we have to do social distancing, so please do register early. Talking about the markets today, the stocks ended higher. They're up about 1.2% now for the week, even after the sell-off that we saw on Monday after the Facebook fiasco. That's the way I would call it. It did pull the markets down, but now we're back up after we got the debt limit extension. The Republicans have sort of gone along with it, and they're going to extend it for a couple of months. So they pushed it out, and that takes away the fear of a default, and then all the talk that would cause a recession and so on. Again, the government does this every now and then. We see that in Washington, that the Republicans, when they're in charge, the Democrats don't want to extend it. When the Democrats are in charge, the Republicans don't want. Just they take it to the last minute, and usually they do get an extension. But the market was a little bit nervous going into today. But yesterday afternoon and this morning, they're still voting on it. So hopefully they'll get that passed and get it to the president's desk so they can extend the debt limit. But that caused the market to take off this morning. It sort of went up all day, and then it just sort of stabilized. When you look at it today, it just opened higher, came back down a little, and then just went sideways today. But a good day in the markets overall. I'm going to talk about these topics in a lot more detail, especially the supply chain problems that we're seeing. Will that translate into higher inflation? That is one of the questions that so many people are asking. And if we do see higher inflation, does that tie the hands of the Fed? Will the Fed have to raise interest rates or accelerate their taper? Right now, the expectation is they're going to do $15 billion. They're going to slowly turn off the tap of the bond buying program that they have. It is expected that they're going to do $10 billion less every month of treasuries and $5 billion less of mortgage-backed securities. They're doing $120 billion a month right now, so they expect that taper that back by about $15 billion. But if the inflation numbers come out stronger than expected due to supply chain problems, the Fed might be forced to accelerate the taper. That means they're going to do a larger turn off the tap faster. And that the market I don't think is ready yet, or that could be a surprise. So we have to look at it, and you can see the delays that we're seeing are the highest they've been since we started in all of this this dramatic decline we saw last year because of supply chain problems, because of COVID. Then we started to get better, but now we've all started to come down, and we're at the highest level of supply chain problems. That's what we're hearing right now and seeing. The amount of money that has been put into the economy, I'll talk about that, and the balance sheets, not only here in the United States, but all around the world. You look at the balance sheet of the US, it was 6% of GDP in 2007. It is now at 37% of GDP. Same thing in the European Central Bank. The ECB went from 13% of GDP to 68% of GDP. Bank of England, which hardly had anything on its balance sheet in 2007, is up to 39%. And the Japanese, if you look at it, they started at 21% 13, 14 years ago, and they're up to 132%. So it's been a tsunami of money that we've been seeing put into these economies all around the world, especially the Western economies. What will this do? Will the dollar be able to maintain its supremacy around the world? Will this depreciate the dollar? Will this cause inflation? All of those questions answered at the webinar next week on the 13th. So tune into that and we'll get into a lot more detail into all of these different things. We'll talk about inflation, if that is sticky or not. I'll talk about the Biden plan, the taxes, who is that going to impact, what impact it could have on the market. We'll take a look at the technicals in a lot more detail. We'll take a look at crypto, not in a lot of detail, but we'll take a look at that also. And we'll take a look at the interest rates, where they are headed. Looking at the technicals right now, we came today very close to the 50-day moving average and then backed off from there. That is at 44.38, the 50-day moving average. Today's high was 44.29, or we got to 44.30. So not quite up to 44.38. That would be a sign to me that this whole thing, after 5 waves, usually we see what is called an ABC correction, or we start 5 waves to the downside. So this whole thing could be turning into an A, B, C, and that would be it. And we're starting a new wave count to the upside. But we need to get above the 50-day. On the downside, we have support right here on the July low, which is around 44.38, I believe, or 43, 42.33. And then we have more support right here, which is getting very close to the 200-day, which is around 41.50. That is major support. If we get below 41.50, then we are getting more than the 10%, and that's not a correction. And that's a real correction. A pullback is between 1 and 10%. A correction is 10 to 20%. A market going down more than 20% is classified as a bear market. So how far down we'll go, I think it will depend on where we go with the Biden plan. Will that be approved? Will the Democrats, the moderates, and the liberals get together and figure that out? And how much are they going to put in? And then we've got the $1.2 trillion hard infrastructure plan, which is being held up by the liberals in the House. They want the other plan, and they want both of them to go forward. I think once we get that out of the way, but tomorrow we do get the unemployment data. It is expected to show 500,000 jobs created. If we get a number much higher than that, that'll mean the Fed is worried about the economy really overheating, inflation, and then we get inflation numbers later on this month, and that will really give us an idea of what speed we are going to get the taper. The taper is expected to be announced in November, but how much? What is the composition? What is the timing? That is what the market might have to go through. It'll also show the seasonal tendency, what the market has done in September and October historically since 1945. Looking at the 60-minute chart, this is each bar, the red and green lines that you see, the vertical lines. Each bar is 60 minutes instead of 1 day. A much shorter picture. It shows that we made a bottom, came back and made a 5th wave. We're starting a wave count to the upside. Came up exactly the 200-hour moving average today, kissed it, and then fell back. But this could be a 4th wave pullback. But we have to hold right around here, 43.75 or so, or 43.70. We closed today at 43.96. So we need to get up and get above this and get going. And if that does, and we can get above the 43.44 area, or 44.40 area, which is the 50-day moving average on the dailies, that would be good. Looking at the Nasdaq weekly chart on the S&P, we're starting to see some, is this the beginning of a 4th wave? Or is this just a little blip like we saw here, little blip like we saw here, or a little blip like we saw here? I don't know. That's something if we do get 4160 is the first number, Fibonacci pullback number, that also gets very close to the 200-day daily moving average. So something to keep in mind over here. On the Nasdaq, we did have an outside day key reversal where we went below yesterday's low today, and then we closed above yesterday's high. Usually that shows that the market is bottoming. And as you can see here, we have an A, B, C. Not like the S&P, which is counting this as 5 waves or a 3rd wave only. This is an ABC. And again, if we get above the 14,884 number, which is the 50-day moving average, I think then this will be classified as a pullback, not even a correction in the market. The weeklies, we came back down to the 20-week moving average. which is around 16,000 to 629. We closed above it today at 16,000 and 14,654. We need to really get going. Usually when we see these dots get on above the market, usually we see 3 or 4 weeks of downside movement. We've seen we're in the third week of this turning to the downside. Gold market really struggling here. Seems like we're starting a wave count to the downside. Wave 1, wave 2, wave 3. We're getting a fourth wave bounce right here. But we have to really hold, if we hold below the 50-day and the 200-day, we have to get above 1801 to really negate this downside. But the downside is 1720, that's the first support. Then this triple bottom at 1675, the 3 lows that we made, 2 in March and 1 in August. If we break 1675, that to me would indicate that the gold market is in real trouble. And then we'll have to start looking at weekly charts, which are somewhere around 1540 in the gold market. If we do get a strong unemployment number tomorrow, that pushes the interest rates to the upside. That is what is having the biggest negative effect on gold. Looking at the Russell, we are still in this sort of triangle, the reopening trade, but we had a good day today. If we can break out above here, which is around 2,300, then we start looking at this whole consolidation area that we've seen since the beginning of the year. If we can get above 2360, that to me will say that we're putting COVID behind us. The small caps, which is I think more emblematic of the reopening, the smaller companies, the smaller restaurants, the reopening of the economy, to me that'll confirm that finally we're putting COVID behind us or getting used to living with it. It's an endemic, not a pandemic, as you heard me say a year ago, that we'll have to learn to live with it. Every year we'll get a different variant, like we'll get a different variant of the flu, we'll get a shot of that particular variant, and that's what we do. Every year we get a flu shot to not get the flu. When we do get the flu, we have therapeutics. That means medicines that we can control, that can control it, and it does not cause severe problems, hospitalizations, or worse. Same thing, we're looking at the Merck pill that is expected to be taken orally. It's going to contain, or at least if you do get COVID, it doesn't affect people. So that will be, I think, what we're going to learn to live with. But post-COVID is going to be different than pre-COVID. Just like post-9/11 was different than pre-9/11. This was an event that is going to change our lives, and we'll have to learn to live with this. Looking at the Treasury note, this is the interest rate. You can see, and that this is the yield on the 10-year. It made a high right here in March, came all the way down, and then it's starting now to get above. It got above the 200-day moving average here. Resistance is going to be right about here, which is about 1.7, and then the highs around 1.77 or so. I would not be surprised to see 1.85 for the 10-year. How will the market adjust to these rates going up? I'll explain a lot more in the webinar next week. Don't forget, you can get the daily update on Market Wrap, the 1-hour broadcast that I do on a daily basis. You can download the free app, and it re-download it every day to your mobile device, and you can basically listen to the 1-hour broadcast that I do every single day, syndicated nationally, that you can listen to and get the update on a daily basis, the 1-hour broadcast. And don't forget, again, thank you everybody that came to Scottsdale. Next week, Zoom meeting. It's a seminar, webinar, not a seminar. It's a webinar where hundreds, and we'll be on it. I will answer your questions, anything you want to know. Then Denver on the 14th, Los Angeles on the 16th. All you have to do is go to compak.com to register right now. You have to have an access code to get into those meetings. Don't forget to subscribe and to get notified whenever I post a YouTube update. When you click on this button, subscribe, you will know whenever I post a new YouTube update. Thank you again for joining me for this YouTube update. Don't forget, next Wednesday, I will be here for about a couple of hours. So it's going to be a quarterly update where we'll take a look at what we expect to see in the fourth quarter and what I'm looking for in 2022. Thank you again for joining me today.
This presentation contains the current views and opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.